Because silver doesn't just trade like a metal, it trades like a mood swing. Before we even touch the miners, we need to clear the fog. There's a rumor flying around that a huge Wall Street bank closed all its shorts at the low of the day. The story goes like this. They slammed the market down, then quietly exited at the bottom, and now they're about to let silver rip higher. Sounds juicy. Sounds like a movie plot, and it's exactly the kind of thing that spreads like wildfire, because it feels satisfying. But here's the catch. Most people are reading the wrong document and they're reading it the wrong way. And here's another detail that almost nobody mentions when they share those screenshots. That report is only for one single delivery month, one slice of the calendar, a single hallway in a massive building. Even if you could perfectly interpret who issued and who stopped on that day, it still wouldn't tell you what's happening in the next month or the month after that, where the bulk of open interest usually sits. It also doesn't tell you whether a position was opened yesterday or carried for months. That's why I don't treat delivery data like a fortune cookie. It's useful as a temperature check, not as a prophecy. For example, deliveries can jump simply because one big industrial buyer decides they'd rather lock in supply now than risk delays later, or because a fund wants to make a statement by taking bars instead of cash, or because a broker is netting client flows. Those are real possibilities that have nothing to do with some cinematic short cover at the low story. So, when you see a rumor go viral, ask yourself, is this information or is it entertainment? Because markets punish people who confuse the two. Every trading day, the futures market spits out a plain, boring report that shows who delivered metal and who received metal for a specific contract month. It's not a secret decoder ring. It's not a confession letter. It's a receipt. And in that daily receipt, people saw the name of a big bank attached to a few hundred contracts and immediately screamed, they covered. Except receiving metal and covering shorts are not the same thing. Think of a futures contract like a promise. At expiration, some promises are settled with cash and some are settled with actual metal changing hands. When you see a bank on the received side, it means the broker arm is involved in taking delivery for that month's contract. That could be for the bank itself. It could be for a customer. It could be a manufacturer who wants the metal for production. It could be a refiner. It could be a hedge fund that decided, forget paper, I want bars. What it does not automatically mean is that the bank closed a short position. In fact, if the report shows them taking delivery, that's consistent with being long into delivery. That's the opposite of the headline people are spreading. And even if we pretend for a second that a few hundred contracts were somehow related to covering a short exposure, let's keep our feet on the ground. A few hundred contracts is a rounding error in a world where the biggest players have giant balance sheets and layers of exposure spread across months, options, swaps, and off-exchange deals that never show up on a simple daily delivery line. So, if your entire trading plan depends on one screenshot, take a breath because the really important question isn't did some bank do a thing? The important question is what did price do, what did miners do, and what does the next set of earnings do to expectations? And that's where this gets interesting. Friday's move was violent. Silver dumped hard in a single session, slicing through levels that had only been broken recently on the way up. It felt like the floor disappeared, the kind of candle that makes your stomach drop. But when you zoom out just a little, something sneaky shows up. The silver price finished Friday around the same zone it traded at roughly 2 weeks earlier. In other words, the market erased a chunk of the recent sprint, not the entire trend. Now look at the silver miners ETF, basically a basket of the larger silver mining stocks. That basket fell too, and it landed back near the same area it was trading when silver was at this level a couple weeks ago. At first glance, that seems simple. If the price was fair, then it's fair now. But I don't fully buy that conclusion. And here's why. 2 weeks ago, the market was in a different emotional climate. Momentum was building, people were chasing, options were getting bid up, everyone was high on the straight line up story. Now, fear is back in the room. Stop losses got hit, weak hands got shaken out, and when volatility jumps, the market changes the way it values everything, especially miners, because miners are basically leveraged plays on the metal with operational risk stacked on top. So yes, the price might be similar, but the psychology is not the same. And psychology is what determines whether Monday turns into a bounce, a dead cat fake out, or the start of a bigger shake. And I'm telling you right now, Monday is going to be a roller coaster. You're going to see candles that look like heart monitors. 1 hour, it'll feel like the crash is over. Next hour, it'll feel like the world is ending. And if you try to day trade it, you can get chopped into pieces even if you're right on direction. Here's what usually happens after a violent move. First, you get the emotional aftershock. The people who panicked sell are out. Then bargain hunters step in. Price pops. That pop triggers FOMO. People chase. Then price whips back down and triggers stop losses again. Then it rebounds again. It's not a straight path, it's a yo-yo. And the yo-yo is designed to punish impatience. So, if you're sitting there with cash because your stops got blown out on Friday, you're not alone. A lot of people got forced into cash without choosing it. And cash feels safe for about 5 minutes. Then you remember what cash is in a world where governments run deficits like it's a sport. Debt expands, currency supply expands, purchasing power leaks away quietly. And you can pretend it isn't happening, but the grocery store doesn't pretend with you. So people look at their cash pile and think, I have to do something. And Monday looks like the moment. But here's the cliffhanger you need to respect. Monday might be the worst day to make an emotional decision because it's the day the market tests your patience. I'm not telling you to buy. I'm not telling you to sell. I'm telling you the environment is dangerous for anyone who needs instant validation. Me personally, I'm not doing anything on Monday. I didn't nail the crash. I didn't predict the exact timing, and I'm not going to pretend I'm a wizard because I'm not. But I can tell you how I think about it. When metal prices crash on paper, the first question I ask myself is, did my physical ounces disappear? I can look at the silver I own, and it's still the same count. The bars didn't evaporate. The coins didn't melt. Nothing physically changed. What changed was the screen, and screens can lie to you in the short term. Now, does that mean price can't go lower? No. Price can always go lower. The market can always make you feel stupid for longer than you expect. But here's the thing. If silver hadn't sprinted so hard in the last couple of weeks, Friday wouldn't have felt like an apocalypse. It would have felt like an annoying down day inside a bigger uptrend. It felt extreme because the move up was extreme. That's why you have to separate emotion from structure. So let's talk structure. Should you be buying silver miners here? I'm going to answer that. But not with a one-liner because miners are not silver. Miners are businesses. They have costs. They have management teams. They have debt. They have jurisdictions. They have dilution risk. They have surprises. And that's why a metal bull market can still produce minor disasters. But it also works the other way. When silver rises, it doesn't just add a little profit to a miner. It can add a lot of profit fast because many costs move slower than the selling price. And here's some fresh context that wasn't in that competitor script. Most primary silver miners aren't truly pure silver businesses. Many of them also produce zinc, lead, copper, and gold as byproducts. That means their profitability can be influenced by multiple commodity streams at once, sometimes cushioning the blow when silver is choppy, and sometimes magnifying gains when multiple metals move together. Also, miners report costs in different ways. You'll see things like cash costs, sustaining costs, and all-in costs. Those numbers include things like labor, diesel, explosives, maintenance, royalties, and the constant reinvestment required to keep the mine producing. So the question isn't just, where is silver? The question is, where is silver compared to the miner's cost structure? And how does that translate into margins over the next 2 quarters? Now, the competitor script talked about last quarter's average silver price being much lower and the next reported quarter having a higher average. That basic point is valid and it matters. But the deeper story is about timing. Markets don't wait for earnings reports. Markets front or run them. And after a big crash, the market often reprices expectations before the numbers even hit. So you need to think in sequences. Sequence 1, the last reported quarter. Many companies sold metal at average prices that were dramatically lower than where silver has been trading recently. That means their reported margins might look okay, but not explosive. Sequence 2, the next quarter's reporting. That's where the higher realized prices start to show up more clearly. If recent market updates stay anywhere near these elevated levels on average, The revenue line changes, and suddenly the same mine looks like a different business. Sequence 3, the quarter after that. If silver holds above prior ranges, the earnings power can start to compound. And that's when analyst estimates tend to get dragged higher, often grudgingly, often late. And that's where the trap is. Because if the market panics out of miners right before the estimate cycle turns, you get a window where the charts look horrible, but the fundamentals are quietly improving. That window doesn't stay open forever. Now, here's the skeptical counterpoint I promised you, because you need it. Higher silver prices don't guarantee higher miner share prices. Why? Because miners can get punched by things that have nothing to do with silver. Unexpected shutdowns, lower grades, political risk, rising energy costs, rising interest costs, equipment delays, or my favorite, share dilution. A miner can be right on the metal and still punish shareholders by issuing more shares at the worst possible time. So I'm not here to sell you a fantasy that miners are a cheat code. What I am saying is this: if silver's average realized price over the next couple of reporting cycles stays materially higher than it was in the prior cycle, the probability of earning surprises increases. And earning surprises are what re-rate valuations. Based on recently published numbers from the broader industrial side of the market, demand pressures haven't magically vanished. Silver isn't just jewelry and coins. It's a critical input for electronics, power systems, and especially solar manufacturing. When solar buildouts accelerate, silver gets pulled into supply chains, whether traders like it or not. And that industrial pull can show up with a lag, which is why short-term price smashes can collide with longer-term demand realities in a very uncomfortable way. Now let's get practical. If you're considering miners, you have to decide what game you're playing. If you're trying to trade a one-day bounce, you're competing with machines, professionals, and chaos. Good luck. If you're positioning for the next several quarters, your focus should be on survivability and margin expansion. Survivability means low debt, decent cash position, stable operations, and mines that can keep producing even when conditions are messy. Margin expansion means selling price rising faster than costs. And costs matter more right now than they did a few years ago. Energy is a big one. Diesel doesn't just fuel trucks, it fuels the entire mining ecosystem. Explosives, hauling, grinding, energy touches everything. Labor is another. Skilled labor isn't cheap, and it doesn't get cheaper during commodity booms. And then there's currency. Many mines operate in countries where expenses are in local currencies, while revenue is priced globally. That can help or hurt depending on currency moves. If the local currency weakens while metal prices hold, margins can widen. If the local currency strengthens, margins can shrink even if silver is flat. That's why miners can move in ways that confuse people who only watch the metal chart. Now, let's bring it back to Monday. If you're looking for a clean signal, you won't get it. You'll get noise. But there are a few things I'd watch for. First, does silver stabilize after the smash, or does it keep bleeding even when it tries to bounce? The quality of the bounce matters. Second, do miners lead silver on the bounce, or do they lag? If miners can't bounce when silver bounces, that's a warning sign. If miners bounce harder than silver, that can signal risk appetite returning. Third, do you see panic volume fade? After a big liquidation, volume often spikes, then drops as the forced selling ends. That transition can be a clue that the worst pressure is behind you, at least for now. And here's the cliffhanger. The next big move in silver often happens when everyone stops staring at it. That's not a mystical statement, it's a positioning statement. When too many people are leaning one way, the market loves to kick the chair out. So right now after Friday, you have a mix of fear and opportunity. But which one wins depends on the next phase, earnings, guidance, and the macro backdrop. Let's talk macro for a second, because this is part of the fresh context too. Silver tends to care about real interest rates, meaning the return you get after inflation. When real rates are high, holding non-yielding metals is less attractive. When real rates compress or go negative, metals start to look smarter. And we're in a weird period where nominal yields can be one thing, and purchasing power reality can be another thing. Even if the headline inflation number calms down, people still feel price pressure in daily life. That changes behavior, it changes politics, it changes central bank posture, and it changes the risk people assign to holding currency. Also, the US dollar matters. When the dollar strengthens quickly, it can pressure commodities. When the dollar weakens, commodities breathe. From recent market updates, currency moves have been jumpy, which is exactly what you'd expect in an environment where investors can't decide whether the next big theme is growth, recession, or policy whiplash. So, if you're only watching silver in a vacuum, you're missing the levers. Also, keep one eye on the companies that don't just mine, but refine, recycle, or stream production. Those business models can react differently in drawdowns. Streamers can look boring until they suddenly don't because their costs are often locked while their revenue floats with the metal. Recyclers can benefit when scrap flows increase after price spikes. Refiners can see margins shift based on throughput and contract terms. None of that shows up if you only watch the headline silver price, but it changes where money rotates when fear hits. It's another reason I like to watch the whole ecosystem, not just the miners. When the market gets shaken, the winners aren't always the loudest tickers. Sometimes they're the quiet ones that keep paying you anyway on days exactly like this. Now, back to the rumor machine. People love a villain and a hero. They love the idea that one big bank is controlling everything. Reality is messier. Yes, big players influence markets. Liquidity is uneven. Derivatives can amplify moves, but a lot of what you're watching is positioning, risk management, and forced flows. When markets get leveraged, they become fragile. A push turns into a shove, and a shove turns into an avalanche. That's why I'm more interested in what the crash revealed than in who to blame. And the crash revealed this. A lot of people were overconfident. They thought silver couldn't drop. They thought miners were a one-way ticket. They thought every dip was a gift. Friday reminded everyone that markets don't care what you think should happen. So if you're going to be in miners, you need a plan that can survive being wrong in the short term. That might mean smaller sizing. That might mean scaling in rather than going Allen. That might mean focusing on higher quality operators instead of the most explosive lottery tickets. And yes, it might mean admitting you don't need to trade Monday. Now, I promised I'd keep this engaging, so let me ask you 2 questions, and I want real answers in the comments. First, do you think Friday's smash was a one-day liquidation event, or do you think it was the first crack in a bigger unwind? Second, if silver rips back this week, are you buying miners, buying physical, or staying on the sidelines until earnings confirm the story? Drop your answers below. I read them and they shape what I cover next. And while you're down there, the description has bonus links, including a premium WhatsApp channel link and a channel membership join link. If you want the extra stuff, it's sitting there. Now, let's talk about the miners again, because this is where most people get confused. They see silver at a certain price and assume miners must be printing money immediately. But miners sell production over time. Some have hedges, some have streaming agreements, some have fixed contracts, some have different mixes of byproducts, and some report results on schedules that don't perfectly match your trading calendar. So the earnings you're waiting for are like a delayed echo. And that's why the market loves to shake people out right before the echo arrives. When year-end results come out, you're not just going to see revenue and profit, you're going to see guidance, you're going to see commentary about costs, you're going to see updates on projects and expansions, and you're going to see whether management teams act like owners or like stock issuers. According to the latest publicly available filings, many mining companies have been emphasizing capital discipline more than in past cycles, meaning they're trying to avoid reckless spending when prices rise. If that discipline holds, it can improve the odds that shareholders actually benefit from higher metal prices instead of watching management light money on fire. But again, discipline is a promise until it's tested. Now, let me share how I'd think about buying miners if I were building a position. I'd split it into layers. Layer 1, the sturdy names, the ones with multiple mines, diversified production, and balance sheets that don't rely on perfect conditions. These are less exciting, but they survive. Layer 2, the mid-tiers with growth projects that can increase output without blowing up costs. These can move hard when the market believes. Layer 3, the speculative names, single asset stories, development plays, explorers. These are where people make and lose fortunes. And after a crash, these can rebound violently or they can keep falling because financing dries up. If you're new, don't start with layer 3. That's how people learn expensive lessons. Now, what about the idea that the price was right 2 weeks ago, so it's right now? Here's the nuance. Price might be the same, but information changed. We just learned the market can drop fast. That increases the risk premium. It increases volatility assumptions. It changes how options are priced. It changes how funds manage exposure. So even if a minor ETF is at the same price, the path that got it there matters. That's why I don't treat same price as same deal. But I also don't treat crash as game over. We could still be in a bigger bull market. Bull markets don't move smoothly. They climb a wall of doubt. They build skepticism. They punish late buyers. And they reward people who can sit still. The question is, can you sit still? Because the market is about to test that. Now, I want to address something the competitor script said that I agree with, but I want to frame it differently. If you were holding physical silver before Friday and you're holding physical silver after Friday, the number of ounces didn't change. The same is true if you're holding miners in a way. If your thesis is long-term, the company's ore body didn't vanish overnight. The mine didn't teleport away, but the market's vote changed. And sometimes the market's vote changes right before the fundamentals catch up. That's why earnings matter. If a miner reports higher realized prices and shows improving cash flow, the market can re-rate it quickly. But if a miner reports higher prices and still shows weak cash flow because costs exploded, that's a red flag. So you can't buy miners blindly. You have to watch the margin story. Here's some additional fresh context. In past commodity cycles, the miners that outperform are often the ones that grow production per share, not just production. That per share part is the whole game. If a company doubles production but triples shares, shareholders can still lose. So when you see big growth plans, ask yourself, how are they paying for it? Cash flow, debt, new shares, and at what price? That question will save you pain. Now, let's zoom back out. Why did silver fall so hard? One explanation is simple. When markets run hot, they attract leverage. Leverage creates fragility. A small push triggers forced selling. Forced selling doesn't care about value. It cares about surviving the margin call. So you get an air pocket. And in an air pocket, everything looks broken. But then the air pocket ends, and suddenly the world didn't end, and price can snap back. That's why I'm not rushing into hero mode. If you want to participate, think like a chess player, not like a slot machine. Now, quick message to the people who are doing well in this market, because I know some of you are. If you're successful, share your success story in the comments so others can stay motivated. Seriously, people need to hear that someone can navigate chaos without losing their mind. And speaking of extra support, we also offer members-only videos. These are produced by a separate team that goes deeper with more research and tighter breakdowns, and they're only for premium members. If you want that extra layer, it's there. Okay, back to the main story. So, what happens next? There are a few paths. Path 1, silver stabilizes, miners rebound, and the market treats Friday as a reset. In that scenario, the next few weeks become a grind higher, and earnings become the catalyst that turns skepticism into buying. Path 2, silver bounces, miners bounce, but then the market rolls over again because broader risk markets wobble, the dollar spikes, or yields jump. In that scenario, you get a series of whipsaws designed to exhaust everyone. Path 3, the crash was a warning, and silver is about to go into a deeper correction that shakes out months of gains before the next leg. In that scenario, miners can fall more, not because the long-term story dies, but because the market needs to rebuild a base. Which path is most likely? I don't know. And anyone who tells you they know is selling certainty. But I can tell you what I'll watch to update the probabilities. I'll watch whether physical premiums stay firm even when paper price drops. When physical tightness persists, it can signal underlying demand that isn't visible in the futures chart. I'll watch whether open interest collapses or stays elevated. When open interest drops sharply after a smash, it can mean leverage got flushed. That often sets the stage for a healthier move later. I'll watch whether miner management teams start talking more confidently or more defensively. Tone matters. And I'll watch whether industrial indicators like manufacturing, demand for electrification, and solar continue to show growth. If the industrial pull is real, it doesn't disappear because traders had a bad Friday. Based on recently published numbers from the energy transition space, the build-out of power infrastructure continues to require massive amounts of conductive materials. Silver isn't the only metal involved, but it has unique properties that make substitution hard in certain applications. That doesn't guarantee price, but it does give the long-term story a backbone. Now, let's circle back to the cash question because that's where many of you are right now. You're in cash because stops triggered or because you sold in panic and now you feel like you're watching a train you got off. Here's the honest truth. Sometimes cash is the correct position after a crash because it buys you time to think. Time is underrated. That can turn a mediocre quarter into a surprisingly strong quarter, and the market often underestimates how fast that can happen. So if the last reported quarter was produced at lower average prices, and the next quarter is produced at higher average prices, you can see a step change. That step change is what leads to upgrades, and upgrades are what lead to re-rating, and re-rating is what can lead to miners moving faster than the metal, but only if costs don't eat the whole gain. That's the key. So the next time you hear someone say miners are cheap, ask them cheap compared to what margins? Cheap compared to what costs? Cheap compared to what risks? Because cheap without context is just a guess. Now, here's another cliffhanger that matters. The biggest moves in miners often happen when they look unbuyable. Right after a crash, charts look ugly. Headlines are negative. People are shell-shocked. That's the moment when the risk-reward can shift, but only for people with a plan.